Every time you hear the government of India talking about Make in India, Atmanirbhar Bharat, the production-linked incentive schemes, electric mobility, defense manufacturing, or making India a global export hub, what usually comes to your mind? Most people think of automobile companies, electric vehicles, or large infrastructure projects. Very few stop to ask a more interesting question. Who actually builds the critical engineering components without which none of these industries can function? That is where today's company quietly enters the picture. This is not the company selling the final product to consumers. It belongs to the engineering and precision auto component sector, the part of manufacturing where products are rarely visible, but absolutely indispensable. It designs and manufactures highly engineered drivetrain systems, transfer cases, precision components, and increasingly advanced electric vehicle transmission solutions. Think of it as the specialist craftsman behind the famous brands. You may never notice its name, but many global automotive companies notice its engineering capabilities every single day. Now, before we talk about the company itself, let's zoom out because every investment story starts much earlier than the company. It starts with policy. India today is undergoing one of its biggest manufacturing transformations in decades. Government initiatives are encouraging domestic manufacturing, localization of critical components, export competitiveness, and technological self-reliance. Automobile production is moving towards higher localization, while global companies are searching for alternatives to concentrated manufacturing bases. India is gradually becoming not just a consumer market, but also a manufacturing destination. This creates what investors call a tailwind. A tailwind is simply a powerful force pushing an industry forward even before individual companies start working harder. Imagine cycling with the wind behind you. You still have to pedal, but every push takes you farther. For engineering manufacturers, the current tailwinds are quite powerful. Domestic vehicle production continues to evolve. Export opportunities are expanding. Premium vehicles require increasingly sophisticated driveline systems. Electric vehicles are creating entirely new product categories rather than merely replacing old ones. Customers now demand lighter, stronger, and more efficient engineering solutions. But every sector also has its headwinds. Global automobile demand doesn't move in a straight line. Commodity prices fluctuate. Geopolitical tensions disrupt supply chains. Technology changes faster than factories can adapt. Customers increasingly expect suppliers not merely to manufacture, but also to innovate. A single delay in launching a new vehicle platform can postpone orders across the entire supplier ecosystem. This is where management quality begins separating ordinary companies from exceptional ones. Many companies simply wait for demand. Better companies prepare before demand arrives. The best companies invest years before demand becomes visible. And according to management's commentary, that is exactly the phase this company believes it has entered. Instead of celebrating only today's numbers, management repeatedly emphasizes investments made over several years that are now beginning to convert into commercial opportunities. Whether through exports, new generation transfer cases, precision engineering, or electric mobility programs. The message is subtle but important. They're not presenting one successful year as the destination. They are presenting it as the starting point of a longer growth cycle. Now let's understand the company's business through a simple mental model. Imagine an iceberg floating in the ocean. Above the water, everyone notices the automobile brands. Below the water sits an invisible ecosystem of engineering companies supplying highly specialized components that determine reliability, efficiency, and performance. That invisible portion often creates enormous shareholder wealth because customers cannot easily replace such suppliers once trust has been established. This company wants to remain in that invisible yet indispensable layer. And that explains why relationships with global OEMs matter more than flashy advertisements. Now let's connect this with the financial picture. Revenue has expanded strongly. Operating profits have improved even faster. Net profits have grown faster still. What does this really mean in plain language? Imagine opening a restaurant. Initially, most of your income goes into rent, staff, and kitchen equipment. Even if customers increase, profits remain modest because fixed expenses consume much of the revenue. But once the restaurant becomes popular, every additional customer contributes disproportionately to profits because the kitchen is already built. Businesses experience something similar. This phenomenon is called operating leverage. Operating leverage simply means fixed costs remain relatively stable while additional sales increasingly flow toward profits. It is one of the most beautiful characteristics investors search for because earnings begin accelerating faster than revenue itself. Management also highlighted improving capacity utilization. Another simple mental model helps here. Owning a factory is like owning a school bus. Whether 10 children or 40 children travel, much of the operating cost remains similar. Every additional seat occupied improves economics. Factories behave the same way. Better utilization often leads to stronger profitability without proportionately increasing investments. Now let's talk about exports, because this is where the story becomes particularly interesting. Many domestic engineering companies eventually hit a ceiling if they depend solely upon Indian demand. Exports change that equation. Exports expand the company's total addressable market, commonly called TAM. Think of TAM as the size of the fishing lake available to a fisherman. A fisherman working in one small pond has limited opportunities regardless of his skill. Move him into an entire river system, and suddenly the possibilities become much larger. Exports effectively move companies into much bigger rivers. Management's increasing emphasis on international markets, overseas subsidiaries, and global customer relationships suggests they're attempting precisely that expansion. Now let's discuss valuation, because a wonderful business is not always a wonderful investment. Many investors confuse these two ideas. Suppose someone offers you a luxury apartment. If the price is reasonable, it becomes an excellent investment. If the same apartment costs 5 times its worth, it may remain a wonderful apartment, but become a poor investment. Businesses behave similarly. There are several ways professionals think about valuation, and each tells a different part of the story. The first is price to earnings, or the earnings multiple. Imagine buying a shop that earns yearly rent. The more years of future earnings you are willing to pay today, the greater your expectations. A high earnings multiple doesn't necessarily mean the stock is expensive. It means investors expect strong future growth. The danger arises when future growth fails to justify today's optimism. The second is the PEG ratio, which compares valuation with growth. Think of it as asking whether the premium paid is supported by the speed of the company's progress. A fast-growing business deserves a richer valuation than a slow-growing one, but only if that growth remains durable. The third is the price-to-book value approach, especially useful for manufacturing companies. Imagine buying an entire factory. This method asks whether the market values the company reasonably relative to the assets it owns. However, modern engineering companies often derive value from technology, customer relationships, and intellectual capability that never fully appear on the balance sheet. The fourth is the discounted cash flow, often called DCF. This is perhaps the purest valuation method. Imagine planting a mango tree. The tree is valuable not because of today's mangoes, but because of every mango it may produce throughout its lifetime. DCF attempts to estimate those future cash flows and translate them into today's value. Unfortunately, small assumptions about future growth can dramatically change the answer, making DCF both powerful and sensitive. The fifth is enterprise value to EBITDA, preferred for comparing manufacturing businesses with different capital structures. Think of buying the entire business, including debt, and comparing that cost with the cash operating profits generated by the factory before financing choices distort the picture. Finally comes the valuation model that markets actually use every day the narrative valuation. Sometimes investors don't buy today's earnings. They buy tomorrow's story. The market often pays premiums when it believes a company is standing at the beginning of a long runway rather than the end of one. This company currently appears to be trading partly on that narrative. And this naturally introduces risk. One of the most important investing principles is called the expectations gap. Markets don't reward companies merely for growing. They reward companies for growing more than investors already expected. When expectations become extremely optimistic, even good performance can disappoint. This is why valuation always deserves equal attention alongside business quality. Another important mental model is second-order thinking, introduced by legendary investor Howard Marks. First-order thinking says, the company is growing. Second-order thinking asks, everyone already knows it is growing. Has the market already priced that into the stock? That single question separates many professional investors from enthusiastic beginners. Now let's connect fundamentals with technical behavior, because these two are often wrongly presented as opposing philosophies. Fundamentals answer why a business deserves attention. Technicals answer when the market begins agreeing with that thesis. Imagine rain clouds gathering. Fundamental research studies humidity, wind patterns, and atmospheric pressure. Technical analysis simply notices the first raindrops. Neither replaces the other. The strongest investment opportunities often emerge when improving business quality quietly begins attracting institutional participation. Long before headlines celebrate success, subtle footprints begin appearing: healthier price behavior, constructive consolidations, improving participation, stronger relative performance, and persistent demand despite temporary market weakness. These are not guarantees, but they often reveal that larger investors may be accumulating positions patiently rather than chasing excitement. This gradual transition from unnoticed opportunity to recognized leadership is rarely dramatic. It resembles water slowly heating before reaching a boil. By the time everyone notices the steam, the temperature has been rising for quite some time. Management guidance also deserves careful interpretation. Interestingly, management is not promising unrealistic explosions in growth. Instead, they continue discussing capacity expansion, export penetration, electric mobility programs, higher utilization, and strengthening customer relationships. Good management often focuses more on controllable execution than on predicting uncertain outcomes. That itself is a subtle positive. However, no story is complete without discussing what could go wrong. Customer concentration always remains a consideration for specialized suppliers. New product programs can experience delays. Export markets may weaken because of geopolitical uncertainty. Electric vehicle adoption may not progress in a straight line. Capital-intensive businesses must eventually demonstrate that investments translate into consistently higher returns on capital. Until that improvement becomes structurally visible, investors should continue asking difficult questions rather than celebrating early victories. Charlie Munger often said that great investing is not about collecting reasons to buy. It is about collecting reasons not to buy and seeing whether the business survives those questions. This company passes many important tests. The sector enjoys supportive policy tailwinds. The addressable market continues expanding. Management appears focused on long-term capability building rather than short-term celebration. Financial performance is improving. Export diversification is strengthening. Technical behavior suggests growing market confidence rather than speculative enthusiasm. Yet valuation reminds investors that quality always carries a price, and future execution must continue matching today's expectations. So the real question isn't whether this is a good company. The more useful question is this: if India's manufacturing ambitions continue unfolding over the next decade, if exports become a much larger contributor, if electric mobility gradually reshapes drivetrain technology, and if management successfully converts today's investments into tomorrow's cash flows, could this quietly become one of the engineering businesses that investors wish they had understood earlier? Or has the market already recognized enough of that future that patience becomes just as valuable as conviction? That is the question worth keeping at the very top of your mind. Every time you hear the words "Make in India," don't just think about the brands you see on the road. Ask yourself instead, who is quietly building the precision engineering that makes those brands possible? Sometimes, the most interesting investment stories begin exactly where public attention ends.
Don't forget to like and subscribe.